It's been a wild week for the markets, but have the storm clouds passed? Welcome to Market Insight. I'm Elena Casas. European shares are on track to claw back almost all their losses from earlier in the week, while Wall Street saw its best day in 2 years on Thursday. Investors are still feeling nervous, though, following Monday's market crash. So how much more volatility could lie ahead? To talk about that and more, I'm joined now by Aoifinn Devitt, CIO of Moneta. Aoifinn, markets look set to end the week more or less where they started it, at least in Europe. But has something fundamental changed this week, particularly the pricing of a US recession?
I don't think anything fundamental has changed. And that has always been why we took this volatility with a bit of a pinch of salt, because nothing had changed in fundamentals. There had been this slow grinding rotation, which was clearly indicative that the top was coming off some of the tech trade. And we certainly knew that unemployment wasn't going to stay as low as it had. It was going to be inching upwards, and it was. And we know the Fed is not going to keep rates where they are forever. So all of that was really inevitable. What was not inevitable, I suppose, was just that coincidence of the yen action, the carry trade unwind, some very bad geopolitical news, some actions by Warren Buffett, and another confluence of events, which really was what caused that fear index, the VIX, to spike. So have we priced in a recession more? Certainly we know that the probability is higher, and JP Morgan this week put it at 35% versus 20%, but that's really a marginal difference. What we're going to be looking at now is those fundamental numbers, whether the unemployment number spikes more radically now, because typically that is the shape of unemployment, slow increases and then a spike.
On the unwinding of that yen carry trade that you mentioned, of course, that cheap liquidity is drying up for investors as the Bank of Japan raises rates. Could that, on its own, provoke more volatility?
It's interesting. We don't yet know the extent of the unwinding of the carry trade. We could only come up with an estimate of the extent that was actually on. It was said to be 4 trillion. That's about 10% of the overall market cap of the S&P. So it is quite meaningful. And if we compare that to the amount in money market funds, which is 6 trillion, it's a meaningful number. But we don't know if all of that was unwound. We don't know if anyone was able to sit and tolerate some losses. And we don't know how pervasive that trade was. So clearly, we probably still have a little bit of it left because it was the only place to borrow cheaply. And risk assets are certainly looking frothy, but it's not just because of the yen carry trade. It's because we've had this sustained rally for now. So we probably could see some action from the yen carry trade. And it's probably a reminder that other concentrated trades are out there. And we don't know yet what the trigger of them unwinding will be and what the impact of the unwind will look like.
One thing that has changed this week, it seems, is rate cut expectations. There's been a lot of talk of an emergency cut from the Fed before their next meeting even, and even calmer heads are now expecting 50 basis points in September. But are you?
I think 50 basis points would be too radical, and coming back from the rhetoric of being data dependent, very cautious, not even assured that inflation was in the rearview mirror. To pivot from that to having some aggressive easing would be quite a sea change. Now, we have a political backdrop to think about. We've even had some headlines around Fed independence today. And I think, if anything, there's going to be a desire to assert independence. Because remember, this Fed is still clawing back its credibility, having lost some for being too slow, perhaps, on the inflation side. So it's clawing back credibility. So it's going to play safe when it comes to action, and especially responding to punditry. So what I think is going to happen is they will do a cut because they know that monetary conditions are tight. I would be surprised if it's 50 basis points, but we don't know what the action in markets will be like between now and September. So clearly there could be something that provokes that.
Here in Europe, Aoifinn, the ECB has been signalling it won't be cutting especially fast, but could we see a rethink on that?
Definitely, if we start to see contagion from that kind of market sell-off. So far, so good in that even the effects in Europe were nowhere close to what they were like in Asia. And Europe was one of the first banks to move, and the Bank of England followed. But clearly, they know that inflation is probably the most assured at being low in Europe versus some other regions. But they know that the economic growth picture there is very shaky. And equally, we're entering the winter now. We still have tensions and some real geopolitical action in Russia, Ukraine. We have the effect that might have on trade and on energy prices. And then we have a potential US election, which could have a further impact on trade and energy prices. So they're going to be very cautious in Europe around the potential for recession. So I think they could actually use that monetary policy in order to avert it.
And what about here in the UK? We've heard a mostly very cautionary take from the Bank of England so far, policymakers stressing stubborn services inflation. We do get fresh CPI data next week, of course, but is the bank going to find they have space to cut faster?
I think they have to cut faster here, but they certainly have to keep cutting. Whether it's faster or not, it depends. And certainly 25 basis points would not be deemed to be too aggressive, what they just did. But we know that the consumer is under more pressure here. We know that they are more correlated to mortgage rates, just of the nature of the mortgage market here. There's that the transmission effect that comes through with the interest rates is faster here in the UK than, say, in the US. So I think they will be very cautious about not having the economy tip into recession. But remember, we had a technical recession here in the UK, and we've already emerged from it. So in a sense, it wasn't actually that bad. A new Labour government is stoking some optimism, some certainty, and has great plans ahead. So I'd say it really is, it could go either way with the Bank of England.
Aoifinn Devitt of Moneta, many thanks for your thoughts. And that's Market Insight. Don't forget, you can watch more videos on Reuters.com.